Enron was once the most powerful energy company in America. Then, in a matter of weeks, its stock fell from $90 to nearly zero. No fire, no recession, just an accounting game hidden for far too long. At the turn of the millennium, America felt unstoppable. The internet was rewriting reality. Stocks only went up, and CEOs weren't just executives, they were celebrities. And right at the center of this optimism sat Enron, a Houston-based energy company that somehow convinced the world it wasn't just selling gas and electricity, but inventing the future of money itself. Its executives spoke in buzzwords, analysts nodded along, politicians smiled for photos. Enron's stock rocketed from the shadows to nearly $90 a share, landing in retirement accounts, pension funds, and employee 401ks across the country. People joked that Enron was too smart to fail. Turns out that joke aged about as well as dial-up internet, because while the public saw innovation, the numbers were already starting to lie. For years, Enron was sold as the smartest company in the room, not just an energy business, but a machine that had outgrown old-school capitalism. While traditional utilities made money slowly, Enron claimed it had evolved. It didn't need to wait. It didn't need patience. Instead, it traded energy contracts like Wall Street trades stocks, fast, complex, and wildly profitable. The magic trick had a name: mark-to-market accounting. Here's how it worked. If Enron signed a 10-year contract, it didn't wait 10 years to earn the profit. It estimated the total future gains on day one and recorded those estimates as revenue immediately. On spreadsheets, it looked flawless. Revenue surged, earnings beat expectations, the stock climbed higher and higher. Executives were treated like prophets. Business magazines handed out awards. Analysts repeated the same line on TV. This company is just playing a different game. And anytime someone questioned the numbers, the response was polite but dismissive. You're thinking too small. You don't understand how modern finance works. When things finally unraveled, the explanation was neat and comfortable. Energy prices shifted. A few bets went bad. Markets panicked. A great company caught in the wrong moment. But that explanation starts falling apart the second you look closer. If Enron was thriving, why was cash quietly draining out the back door? Why were executives cashing out hundreds of millions while employees were locked into company stock? And how does a business worth tens of billions collapse so fast it feels like someone flipped a switch? Because what the public was shown wasn't a lie, it was a performance. What if Enron wasn't hiding losses, but hiding entire companies designed for one purpose only: to keep you from ever seeing the truth? Enron didn't hide the truth by lying. It hid the truth by breaking it into pieces so small that no one could see the whole picture. Instead of reporting losses like a normal company, Enron created hundreds of entities that lived off its balance sheet. On paper, they sounded harmless: LJM, Chuco, Raptor, names that felt more like internal projects than financial weapons. But their purpose was simple. They existed to absorb Enron's mistakes. Whenever a deal went bad, the loss didn't stay on Enron's books. It was quietly moved somewhere else. The debt disappeared from view. The profits stayed right where investors could see them. Quarter after quarter, the numbers looked strong. Revenues climbed. Earnings beat expectations. But cash told a different story. Here's where it crossed the line. These entities weren't truly independent. Several were secretly controlled by Enron executives themselves. The same people managing risk for the company were personally profiting from the structures designed to hide that risk. Banks understood what was happening. Accounting firms signed off anyway. Ratings agencies kept Enron investment grade. Not because the system worked, but because everyone was getting paid. And the complexity did the rest of the work. The structures were so confusing that analysts stopped digging. Executives hid behind jargon. Regulators struggled just to map the flow of money. Meanwhile, the warning signs stacked up: exploding debt, weak cash flow, executives quietly selling their own stock. Nothing collapsed yet because confidence was still intact. But once you build a business on hidden losses, there's only really one risk left. Someone eventually turns the lights on. This is the moment accounting turns explosive. One small question, one analyst refusing to nod along, and suddenly a structure built on confidence starts collapsing under its own weight.
At first, nothing exploded. That's the most dangerous part.
In early 2001, a few analysts began asking inconvenient questions. Simple ones. Where is the cash? How much debt is really off the books? Enron's response was denial wrapped in confidence. Executives reassured investors. Conference calls sounded calm. The stock barely flinched. Then the chain reaction started. One disclosure forced another. One shell company led to two more. Losses that were temporary turned out to be permanent. By summer, insiders were sprinting for the exits. Top executives sold millions in shares. Employees locked into Enron stock through their retirement plans were blocked from selling due to a system upgrade. That wasn't just bad luck. That was catastrophic timing. By October, Enron admitted it had overstated earnings by nearly $600 million. Credit rating agencies panicked. One downgrade triggered another. And that's when the real fear hit. Trading partners stopped doing business. Banks demanded collateral. Liquidity vanished overnight. The stock didn't fall, it collapsed from $90 to $30 to single digits in a matter of weeks. What followed was pure financial absurdity. Executives claimed surprise. Auditors shredded documents. Politicians distanced themselves. Employees showed up to work to find their life savings erased, not shaved down, erased. Pension funds across the world took hits. Trust in corporate America cracked. And here's the controversial truth. This wasn't caused by one bad decision. It was caused by thousands of small ones. Each justified, each signed off, each ignored, because the stock price kept rising. Greed didn't flip a switch. It nudged the system forward until the system finally snapped. It ended the way most financial disasters do. Not with chaos, but with paperwork, lawyers, and a signature at the bottom of a page. In December 2001, Enron filed for bankruptcy. At the time, it was the largest collapse in U.S. history. More than $230 billion in market value didn't just disappear, it was revealed to have never truly existed. 1 week earlier, Enron was still being discussed as a temporary problem, a misunderstood giant, a confidence issue. Days later, the stock was trading for pennies. Employees walked out carrying boxes, while posters about innovation and integrity still hung on the walls. Security guards stood where ambition used to be. And the punchline was cruel. The company that promised to eliminate uncertainty collapsed the moment it was forced to show real numbers. Executives negotiated exits, lawyers prepared defenses, auditors erased their footprints. What died that week wasn't just a company, it was the belief that complexity equals intelligence and that rising stock prices mean truth. The trick was over, and for the first time, everyone saw the wires. You'd think this was the end of the story. It wasn't, because the real damage didn't happen on Wall Street. It followed people home. The hardest hit wasn't Wall Street. It was living rooms, homes where people believed that doing everything right would protect them. More than 20,000 Enron employees lost their jobs almost overnight, but that was the visible damage. The real destruction was quieter. Retirement accounts, 401ks heavily concentrated in Enron stock, the same stock executives publicly praised while privately dumping millions of dollars worth. Some employees were 55, some were weeks from retirement. None of them were reckless investors. They trusted their employer. And the shock didn't stop in Houston. Pension funds, universities, local governments, all absorbed losses from a company that looked stable only because risk had been carefully hidden, not eliminated. Even Arthur Andersen, one of the world's 5 largest accounting firms, collapsed in the aftermath. Not from bankruptcy, but because its name became worthless. A signature that once meant credibility now meant suspicion. Lawmakers rushed to respond. Sarbanes-Oxley promised transparency, oversight, accountability, but there was a deeper lesson no regulation could fully fix. Enron proved you don't need outright lies to break a system. You only need statements that are technically true, legally defensible, and so complex that no one wants to question them. It didn't teach Wall Street to cheat. It taught Wall Street to hide risk behind intelligence. And that lesson didn't die in 2001. You saw echoes of it in 2008. You still see it in adjusted earnings, in financial products that discourage understanding by design. After Enron, the most dangerous question in finance stopped being, is this risky? It became, who will be holding it when the truth comes out? Nobody woke up in 2001 expecting a collapse. Everything looked normal, audited, approved, confident. That's why Enron matters. It proved a system can look healthy while rotting inside, as long as appearances are rewarded. Complexity didn't reduce risk, it buried responsibility. When no one fully understands how money is made, everyone gets paid, until the damage lands somewhere else. The lesson isn't watch out for fraud. Fraud is obvious in hindsight. The real warning sign is confidence without clarity. If a company can't explain how it makes money in plain language, it's not because you're uninformed, it's because understanding would be dangerous. The next collapse won't start with panic, it will start with reassurance.
If you enjoyed this video, hit like and subscribe for more cool stuff they don't teach you at school.